Hello and welcome back to our lecture for Chapter 10, Stockholders' Equity. We're going to look at now the accounting for retained earnings, dividends, and any stock splits. You should be quite familiar with retained earnings by now, right? Net income, then you have less losses, less dividend declared. And remember, these are permanent accounts, so it's accumulated over the corporate's lifetime. So basically on your balance sheet, you see everything from the inception of the company. So a credit balance leads to earnings, leads to, less losses. And so as long as our credit balance is greater, we have earnings. If our debit balance is greater, we have losses and dividends. Dividends are what you distribute to its shareholders based on earnings. You can distribute cash, stock, or any other non-cash items. But basically cash and stock are the two most common. So for cash dividends, basically what you have to compute is, in order to pay cash dividends, they have to be paid from retained earnings. So you have to have enough retained earnings to declare it, and you have to have enough cash to pay it. You cannot declare a dividend without having the cash to pay it. The declaration date is important, the date of record, and the payment date. So we'll talk about all of those. So the declaration date, you actually have to put the liability in. So if on June 19th, the board of directors, we now declared a $50,000 cash dividends, you'd record that to retained earnings as a debit, and then you'd credit dividends payable. And this would probably be just a dividends account in this case. And you see the effect on the accounting equation. You're payable, and here is your dividends, which is a contra equity account. Then on July 10th, the payment date, we actually paid the dividend. So we paid the full $50,000. So we're going to debit dividends payable and credit cash. Now we are on this side of the equation. This is our cash, and here is our payable that we are reducing. So when you're looking at the retained earnings account, we've gone through this a few times. So here's your beginning balance, net income. Dividends is obviously on the debit, and then you get your ending balance. So let's actually look at this corporation, what we have on our stockholders' equity, and we're going to journalize the transaction to record a declaration and a payment of a cash dividend of $32 million. So in this case, we're going to debit retained earnings for $32 million, and we're going to credit dividends payable. Then when we pay it, we're going to debit dividends payable to wipe this out, so we would have then the cash that's being paid. Dividends are preferred stock are paid first before the common stockholders, and it is stated at a percentage of par value or a dollar amount per share. And you may have cumulative preferred dividends, which means that any past dividends are owed to the preferred shareholders. We call this dividend in arrears. So here, dividends on preferred stock, let's assume that our preferred stock is cumulative, and basically we passed the preferred dividend of $150,000, but before paying the dividends to common, we must first pay our preferred dividend shareholders $150,000 for both 2013 and 2014. So that's each year. So on September 6th of 2014, we declared a $500,000 dividend. The entry to record all of these dividends, here's our $500,000, and then here's our dividends payable to preferred. They have to come first, and then our additional $200,000 for the common. Now, if we are looking at Arizona Manufacturing and we have this information for December 31st, we have preferred stock, look at that dollar par, and we have 30 cents par for common stock, and we paid all preferred dividends through 2011. We want to compute the total amounts of dividends for both preferred and common for the 2 years if the total dividends are $90,000 in 2014 and $270,000 in 2015. So our $90,000, if we have dividends in arrears, we have to pay that first. So 2 years at our $5,400, that's what's in arrears. Then our current year, we have to pay that prior. Then we can go ahead and give the remaining to the common shareholders. And then our current year, we have to put, again, our preferred. Then the rest can go to our common shareholders. So make sure that you understand that. Always you have to calculate the dividends in arrears for the preferred stockholders, and then you can go ahead and the remainder goes to the common stockholders. So stock dividends are basically, they increase the stock account and they decrease your retained earnings because it is still a dividend. So the equity is unchanged. The reasons you tend to do stock dividends are distributed basically to continue the dividend streams, but not actually necessarily spend the cash. And your stock splits is really no accounts are affected because all you're doing is just dividing your stock. So these are similar effects. What happens to assets, liabilities, and owner's equity. In your exam or in anything, I would recommend you look at the journal entry. Make sure you record the journal entry, see what journal entry you need to record, and then you'll see the effect on the accounting equation here. So let's now move our attention to stock values and decision making. You should have this price earnings ratio, which is your market price of one share of common stock over your EPS or your earnings per share that we talked about previously. So that is good. You want your PE to be higher. And then you have redeemable preferred stock, which just basically requires the company to redeem the stock at a set price. You have liquidation value, which is the amount that the company must pay to its preferred shareholders in case it goes out of business. And your book value per share is the amount common stockholders' equity on the company's book for each share of stock. So here you see all of the DuPont analysis, which basically relates to our net profit margin and our asset turnover ratio. Notice here the new piece we're adding is we have to subtract preferred dividends from our net income. So please ensure that all of these formulas are also in your Excel template. And lastly, let's talk about the reporting of these transactions, stock, the issuance of stock, treasury stock, and dividends. They are all reported on the statement of cash flows in the financing section. You'll remember the statement of cash flows has operating, it has investing, and financing as the primary three sections. So all of these transactions dealing with equity goes into the financing section. And basically what you see here is a statement of stockholders' equity rolled forward from one year to the next, and then all the columns represent the various categories in there. So this is very typical of this schedule, and you would possibly give this to your auditors and show that you rolled it forward properly. And lastly, what we have is basically now a more detailed stockholders' equity section. You see preferred stock listed first, the percentage and the par value. You see your common stock par value. Notice how many shares are authorized, issued, and outstanding. Here's your additional paid-in capital and your retained earnings, and here's your less reducing it by your treasury stock to get to your total stockholders' equity. This concludes our lectures for Chapter 10.